This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.
Please speak as you might to a young child or a golden retriever.
It's an unfair game.
They're schemers. Schemers trying to control their little worlds.
Rich get richer, that's the law of the land.
It's just money.
Blasphemy! This is madness!
I drink your milkshake.
Hey everybody, welcome back to Milkshakes, Markets Madness. This is a show, not a podcast. My name is John Kutsmita. This is Brent Johnson. We come to you every week, sometimes twice a week, to talk about financial markets. That's the clever markets piece of our name. The milkshakes part, you're going to have to dive a little deeper if you're not familiar with. That is referring to the dollar milkshake theory, which Brent Johnson came up with to explain the monetary system, the global financial system. It's a very helpful anecdote to break down some of these complex themes. So please visit our website at milkshakespod.com to learn more. And the madness, well, every week it seems like there's no shortage of madness. So Brent, why don't we jump in on some of the madness? Before I do, tell me, how you doing? How was your week?
I'm good. It was another violently sideways week. The market, opened up, then sold off really hard, and then had a monster rally today, and we had a Fed meeting in between. So just another typical week for 2023. I mean, it's just, it seems like it's Groundhog Day. Every week is Groundhog Day.
Yeah, Groundhog Day. What a great movie. It's like this weird violently sideways sandwich. Every week there seems to be a ton of things just stuffed between two slices of frustrating bread. And this week we had a number of things. We had rate hikes, non-farm payroll, bank takeovers, collapses. Gold was a big hypey thing. So let's go into all of it. What are your thoughts on the FOMC rate decision? Another 25 basis points. Now we're at what, 500 bips?
Yep, 500 to 525. Yeah, I mean, I think it was largely expected. I don't think it was any shock. It was kind of interesting because once he said what he was going to say, once the announcement came out, it was basically what everybody had thought it was. And so there wasn't a huge reaction. I think markets bounced a little bit, but it wasn't huge. And then, so it was all going to hinge on the press conference, right? Which is often the case anyway. And what I found interesting is that the market kind of went up and down while he was talking. And I even messaged my friend Keith and I said, nothing's going to happen until he shuts up. Because as long as he's talking, he can either say something bearish or he can either say something dovish. And so the market's going to keep fighting itself. But once he shuts up, then something's going to happen. And that's kind of what happened. Market sold off pretty hard. Not hard. It sold off after he stopped. And then, the next day was down pretty hard. But then, we wake up today and we had a non-farm payroll. The non-farm payroll came. Well, this was interesting. Non-farm payrolls had a massive beat. But then it also, the previous month was revised down. So you had both a beat and a revision down. And what I found interesting is the gold took it as bearish or as dollar strength. And so gold sold off pretty hard today. The dollar was up big initially and then sold off by the end of the day, which kind of has been par for the course for the last 6 months. But equities just took off. And NASDAQ didn't take off right away. The other markets were before the NASDAQ, but by the end of the day, NASDAQ had just eclipsed both of them. So, I think what Powell did was largely expected because he didn't do anything totally out of the normal. Markets like certainty. They don't like uncertainty. And so I think because he came out and did kind of what everybody was expecting, maybe it initially sold off, but then today, he said we were going to be data dependent, and as I think maybe with the revision coming in weak, that people are thinking the data is slowing. Maybe they're thinking May was a one-off event, and so by June, they're not going to see any reason to hike anymore. But to me, the big thing is everybody just keeps saying Powell doesn't know what he's doing. Powell doesn't know what he's doing. He's going to hike rates and he's going to crash the economy. Well, I'm not a fan of central bankers, and we've talked about this several times, but the guy's not an idiot. He knows that if he raises interest rates, interest payments are going to go up. And he knows that, that having a long duration in your portfolio is not great if interest rates are going higher. He literally talked about it. I can't remember if it was in a paper or at a conference 10 years ago where he discussed this exact thing. So the idea that Powell doesn't know what's going on and he's just oblivious to what's happening around him, I think is just completely wrong. Now that said, it wasn't great for him to come out and his very first words were, the banking system is strong. And then, 2 hours after his press conference is over, PacWest, I think it was, says they're exploring the, strategic options, which is code word for we're in deep shit.
Yeah, totally. So one of the, maddening pieces about, last week it was for me, at least, I think one of my favorite conversations, because I think not only did we kind of pack in various sprinklings of all the themes that we've talked about or the bigger themes we've talked about so far this year, but we kind of flipped it on its head and openly were questioning or challenging our viewpoints. And, you have an event that's significantly important, like an FOMC meeting rate decision, and they raise interest rates, and you talk about the various knock-on effects and or the people saying the central bank doesn't know what they're doing. And one of the things they also like to point out is kind of this corrupt nature of the central bank. The owners of the Federal Reserve are banks. And so it's kind of one of these catch-22, or really just people being intellectually lazy in that, do you think the Federal Reserve is going to be making decisions that are blindsiding or going to put the overall banking sector in jeopardy, ultimately the owners of the Federal Reserve and those who are really probably behind the curtain driving a lot of these policy decisions? So sometimes I feel like there's this, like we always say, there's this maddening emotion that takes over and people aren't looking at all the pieces of the puzzle.
Yeah.
They're just looking at, kind of one version of it.
Yeah, to me, it's just very inconsistent thinking. You can't, on the one hand, say the Fed is there to do everything for the banks and ensure that they always come out on top, and then on the other hand, say he doesn't know what he's doing and he's got to blow up the banks. It's, again, whatever your opinion is fine, but I think one of the things we always try to do here is try to think through things, see both sides of it, and kind of have a consistent way of thinking about things. One of the other things that kind of popped up this week, which kind of dovetails around the Fed meeting and the non-farm payrolls today, was gold, as you mentioned earlier. And a friend of mine, I'm going to highlight this because I think this is a great example of keeping an open mind. And I know many times, John, you and I have talked about this, but this is an example of somebody else doing it, somebody that I really respect, somebody who I think is very smart. And his name's Ben Davies. He's from London. He used to run a gold fund. Now he's an entrepreneur, very successful. And listen, this guy is long-term bullish gold. He understands. This guy knows as much about gold as anybody, and he's as bullish gold as anybody. And he understands in the long term why gold is going to go higher and why fiat currency is going to go lower. And he put out a tweet yesterday that said, even though he is a gold bull, in the short term, he thought that we were going to have another pullback before we break through 2100, right? And I respond, first of all, I thought that was fantastic because not too many people have the ability to kind of think critically about something that they're passionately bullish about, right? But here he is, and not only is he doing it, not only is he challenging his long-term assumptions, but he's putting it out there for the public to see and to ridicule, which is what everybody does on Twitter, right? And so I just responded and said, I agree with you. And then somebody responded to me and said, what are you talking about? You've been bearish gold for 5 years or something. And I'm like, first of all, I haven't been bearish gold for 5 years. I've owned gold for 5 years. I've bought gold for clients every year for 5 years. I just bought gold a month ago for a client. So this idea that I've been shorting gold for 5 years is completely ridiculous. But anyway, but then, but Ben had a couple of reasons why he thought gold was going to pull back. And so I started messaging with him and I gave him my reasons. And I actually bought puts yesterday, and I told him I bought puts yesterday. And the reason I bought puts yesterday, and part of the reason I think Ben was expecting a pullback, and he had some protection as well. I don't know exactly what he did, but he had downside protection against his long-term gold position. Again, what exact form he did it, I don't know, but I'll tell you what I did is, we bought the 2040 puts. Gold was trading around 2050, 2060, and we bought the 2040 puts. And I'll tell you why I did it. Not because I hate gold, not because I'm bearish gold, but because all the signals that I follow were firing kind of on the level 10, right? One of them is the COT report is starting to get a little bearish again. It's not totally bearish, but it's starting to get bearish again. And with the run-up that we've had in the last week, I figured that the speculators added to their position, and I figured the commercial short, added to their position. That typically doesn't work out well. The other thing was that the RSI on gold was getting pretty high. The other thing is that the DSI, which is a measure of sentiment, was in the mid-80s. Now, anything in the 80s is getting extreme, and anything in the 90s never lasts very long. And whenever you get a sentiment reading in the 90s, you're always going to get a pullback. Now, the pullback might only last 1 or 2 days, might only last a week, and maybe then it will rocket higher, but you're not going to have a chart that just goes straight up. And then also with everybody on Twitter being so bullish, I was like, well, and we had a NFP coming out today, and I thought the number was going to be good. And so we bought puts. And so today gold was sold off very hard, right? And the hardest thing to do is either buy protection or short gold at the high, because it's one of these things that if you're wrong, gold's probably going to $3,000 or that's what's going in the back of your mind, right? Because that's what the gold trade is. The gold trade is the total breakdown, Armageddon trade. And so if you get it wrong, it can go against you pretty hard. And that's why it makes it hard to do, even though all the signals are telling you that's what you should do. But so what we did is we bought the puts. And so today gold sold off really hard, and we were able to sell the puts for enough, and then we rolled them to the 210s. And so now the amount of money we made on the 240, we took all our capital off the table, and it paid for the 210s. And so now we have 210 puts for free. Now, the reason I did it is, again, not because I think gold is going to crash or go to zero or, that its bullish long-term potential is gone, but I think in the short term, it's under pressure. And so because everything was firing, even though my short-term signals were going counter to my long-term belief, the same has been. And so I wanted to highlight he did it. And if it actually helped me have conviction to do it, him having conviction to do it, because I know how bullish he is and I know how smart he is. And so the fact that, again, that he's challenging his own assumptions, kind of doing a short-term trade counter to his long-term thesis, kind of helped me do the same thing. And so I don't know if we'll be able to put up some of the charts and some of the signals that we just talked about, but I thought that was a great... I always appreciate it when people put their opinion out there and, open themselves up to either ridicule or praise. In this case, it worked out well for him, worked out for me. There's many times it doesn't work out, but that's the way the game goes.
So you've talked a lot about the structure of your portfolio. Kind of, there's very clear themes in the long run based on the dollar milkshake theory and various aspects of that. So you have this long-term portfolio that you don't really touch a whole much or adjust frequently, I should say. It's there, right? You do make adjustments, but you're not trading it. Defensively, your insurance, I would presume, similarly doesn't move a lot, or you're assessing last week. Sometimes insurance and defense can have a drag on portfolio performance, but how important it actually is. Now, when you go into something like this, I say this kind of like gently, but are you just having fun with your day? Like, is this a meaningful decision in terms of what you're trying to do for your clients, or is it kind of just,
That's a very good question. It's a little, honestly, it's a little bit of both. And the interesting thing is, if you read The Alchemy of Finance by Soros, and listen, I shouldn't even mention myself in the same sentence as Soros, because that's kind of sacrilegious to do that. But, if you read his book, he talks about having a long-term portfolio and a short-term portfolio. And again, you might have some long-term themes and you have some short-term ideas. This was a case where I was kind of doing both. Well, and there's a benefit to having a short-term portfolio, and that is it allows you to scratch that itch, right? I think a lot of people intellectually know that overtrading will kill you, and you're better off getting some long-term themes and just sitting there. Like Jesse Livermore said, just sit tight and be right, and you make more money doing nothing than by constantly trading. But all of us have that itch to kind of go do something as well. And so if you have a smaller second portfolio that allows you to kind of scratch that itch and do some tactical things along the way, I think it keeps you from screwing up your long-term portfolio, and it keeps those long-term themes in place. And so this is yesterday was a very good example of, we own gold for all our clients. And this was a point where all the signals were telling me to short gold. Emotionally, I didn't want to do it, but all my signals were telling me I needed to. And so that's usually a pretty good sign. The harder the trade to do is usually a good sign that it's the right trade to do. And so to answer your question, it was purposeful. I did it with the idea that I expect gold to pull back. And I'll tell you again, part of why I expect gold to pull back further. I think it could easily go back to 1950, 1900, 1850, somewhere in there. And who knows? And maybe I'll change my mind tomorrow, but as of right now, I think that's the case. Part of the reason is the dollar is very, very oversold. The dollar is due for a bounce. Even if you think the dollar is going to 90 or 80, it's due for a short-term bounce. So that's coming up. There's a lot of other things that are happening in the world that could cause the dollar to squeeze higher, whether it's the debt ceiling or, we've got a inflation report next week. And typically in the short term, dollar and gold typically trade inverse. Now, I think long term, dollar and gold are going up together, right? But in the very short term, I could see that go the other way. And so I thought this was a good opportunity to protect money that we have made year to date in gold. So that's part of the reason that I did it. And I think that next week, here's my guess, and who knows? And again, maybe I'll change my mind when I wake up, but my guess is that, when we get maybe gold will bounce early next week, but I think when the inflation print comes out next week, I think it's going to be hot. I think it's going to be hotter than people expect. And I think gold will probably react negatively to that. Now, if it does, I'm going to be good because I have these puts and I have them for free now, right? And if I'm wrong and gold spikes higher and breaks through 2100 and we're off to the races, well, that's great because we own gold. So I think that's how I see, keeping your long-term portfolio in place, but then doing some things tactically on the side to protect your long-term portfolio and also to, again, scratch that itch of your own so that you don't screw up your long-term portfolio.
So we're in the deli. We've got our violently sideways sandwich. We just talked about some of the deli meats that are stuffed in there. I'm gonna try to add some more accoutrement in there and see what your thought is on the flavor. So you mentioned the inflation print. We didn't really talk about NFP too much. You did kind of graze past it. What was interesting was the adjustments lower than the previous months. What's also interesting is this is the 13th month of a beat. So we continually outpacing expectations, which is like a huge multi-sigma move. Also, so you have the NFP, you have the inflation print, and you also have this debt ceiling shenanigans kind of coming to a head here. So of those three things, stuffing that into this violently sideways sandwich, one, the inflation print, why do you think that's going to be hot when we've talked multiple times and you've mentioned multiple times that the month or the year over year comparison is going to be, this time last year, or maybe this is the last month where we don't really start to see those really high prints. So you mentioned last year, hey, we're starting to get into the 7, 8s, 9s. Yep. So now if we have a 4.5%, it's down, but are you, again, I guess, referencing expectations? And then the other bits with the debt ceiling, you just talked about how you think there's going to be pullback on gold and dollar's going to, have a short-term rally potentially, but that kind of conflicts with a narrative around the debt ceiling being raised because immediately the Treasury is going to puke out a bunch of T-bills.
Yeah. So the way I would say it is that I think with next week in the inflation print, it's not that I think year over year inflation could come down, but I think it will probably beat expectations. And part of the reason I think it will beat expectations is, for the most part, the market has held up, right? I mean, I know we've had issues with the banks, but for the most part, I think market has held up. And it wasn't until, and a week ago, oil was at $80, or 10 days ago, oil was at $80. It's only in May where oil has sold off. And so oil went from like 80 to 60. Oil went all the way to 64 the other night. I don't know if you noticed that or not. And now it bounced back up and it's like 70 or 71. So I think April could be the last month where we have a fairly strong inflation number, or at least one that beats expectations, or is at least strong enough that will put the fear into people that maybe Powell will hike one more time, right? And maybe that belief will only last a day or two, but that's kind of why I see it. Now, I think once we get into June, July, August, then we're going to be in the heart of it. And to your point, we've talked several times, we think inflation's probably going to be coming down fairly significantly at that point. And it's for that reason that so many people are upset at Powell continuing to raise rates. They just can't understand why he continues to raise rates. When we see this obvious slowing and we see these issues with the banks. Now, the other thing that you said with the debt ceiling, I'm not sure which way you were going with this, but one thing I would say to people that think that we're going to raise the debt ceiling, we're going to issue more bonds, and then therefore that's going to be negative for the dollar because there's going to be more debt to pay off. They'll never be able to pay it off, and that'll mean the dollar weakness. But it's actually the opposite. And let me explain to this. The Treasury needs money, right? So the Treasury has demand for dollars. The Fed is not printing money right now. They are still raising rates. They're still doing QT, and they're tightening policy. They are not currently loosening policy. So if the Fed needs money, if the Treasury needs money, where do they get it? They get it from the market. So when they come out and they start issuing Treasury bonds again, that is demand for dollars that has been on the shelf for the last 6 months while we're up against the debt ceiling. When they start selling bonds, they're going to be pulling those dollars back into the Treasury. That's demand for dollars. That typically actually pushes the dollar higher in the short term. Now, in the long term, it's more debt they have to pay off. They're probably going to eventually have to print the money to pay off the debt. And so long term, again, this is long term versus short term, right? You got to understand the difference between a long-term consequence and a short-term reaction. The long-term consequence is it's probably not great for the dollar. The short-term reaction is that it probably pushes the dollar higher. And if you look at historically, this is the case. And again, it's not a perfect signal, and of course, there's always exceptions. But if you look at if you overlay the growth of U.S. debt over the chart of the DXY. Typically, when you bump up against, the line is always going higher, right? We're borrowing more and more and more. When you bump up against the debt ceiling, the chart flatlines. And typically during that flat line, when the Treasury is not issuing more bonds, that means the Treasury is spending money into the economy, and they're not simultaneously draining it by issuing bonds. So they're actually flooding the market with liquidity. We've talked about this before. This is where Yellen's policies have been offsetting Powell's tightening policies. It's because they're up against the debt ceiling. So historically, when we've been up against the debt ceiling and the Treasury is putting money into the market and not draining it, that's been weak for the dollar. But as soon as the debt ceiling gets raised and the Treasury starts issuing bonds again, the DXY typically tends to rise. So again, that's another case, and I think that could get resolved in the next 2 weeks. Or maybe they kick the can down the road for another 2 months. I think the White House came out this week and said they were potentially open to doing kind of a short-term 1 or 2 month, 3 month extension of the debt ceiling. So anyway, there's a number of factors. And then we have the bank issues, right? If more banks start to go down, this was another thing I was talking to people this week. Again, you have to understand the short-term reaction versus the long-term consequence. If banks fail, that's not bad for the dollar. Bank failures are deflationary. If a bank fails because of deposit flight and because it's a bank run, that's because there's a lack of dollars. There's a lack of liquidity. That pushes the price of the dollar higher. That makes the value of each dollar higher. Now, the reaction to that, the reaction from the government to the dollar coming into great demand because of the deflationary pressures of a bank failure, that could be inflationary. And we talked about this a couple months ago. Remember, John, we talked about, we know there's a hole. And when the Fed comes in and does QE or does some kind of a bailout, they're trying to fill this hole. Now, if they're putting more into the hole than the hole is deep, then you'll get inflation. But if they're trying to fill a hole that continues to expand, you still have deflation. And so you got to pay attention to the reaction. But if you think that they are going to have to turn around and provide liquidity in a massive way in the next couple months, then that means you're actually bullish the dollar in the very short term, and you think that this reaction is going to come in to try to tamp that down.
Awesome. So I want to stuff a few more things into this little violently sideways sandwich. We've got so we talked about non-farm payroll really briefly again, and then you added a few more spices on it. One of the things I want to mention in relation to your answer regarding inflation in year over year is one of the sectors that's usually the most inflationary has been the most active in the non-farm payroll, which is the services sector. Now, you also mentioned liquidity, and it's interesting to think about the lack of on-balance debt expansion with the Treasury means they're spending liquidity and cash into the market, which increases liquidity and kind of adds a bit of a bump to potential inflation readings, especially adds a potential bump to liquidity readings. And I think it's cross-border. That's one of the things that they kind of monitor frequently, and he's always putting out a chart. And that's one of the things that he's been kind of walking a tightrope on is like, is this the bounce off the bottom of liquidity in the beginning of the next cycle up? Or is this some sort of noise in the system because of some of these other things that are going on? So it's going to be kind of interesting. But with all of that kind of packed in there, I want to kind of hear your thoughts on, talking about the Fed, talking about the Powell knows the pain he's causing. It's ultimately intentional. Maybe there's an element of arrogance or how far they think they can take it. What is your reaction? What is your feeling about those people that maybe they're contrarian for contrarian's sake? Maybe they're just sucking in attention while they can get it. But it's real easy when you're not making policy decisions to say, oh my God, the Fed is so stupid. They should already be cutting. Look at all this, forward-looking indicators. What do you think about those opinions? Are they so off base, or is there some sort of reality to where they're coming from?
Well, let's take both sides of it. We'll talk. So there's like Michael Howell, who runs cross-border capital. He's been looking at the liquidity, and he's saying that we potentially have already started the next liquidity cycle, right? And that we're going to have increasing liquidity up in the next year, and that's possible. I cannot say that that's not possible. Where I struggle a little bit with that is that, in my opinion, we need some kind of a catalyst to allow the central banks to kind of, quote unquote, roll over and start providing further liquidity, right? I don't think with everything the way it currently is, they could pause, and that would provide a little, I guess, excess liquidity. But for them to turn back on the spigot, so to speak, they need some kind of an event or some kind of a, crisis that gives them the cover to turn the spigots back on so that we could get another year or 2 years of liquidity. So I'm not saying it can't happen, but I struggle to see it happening without an event. The flip side is someone like Jeff Snyder, who I have total respect for, and I think, I don't want to put words in his mouth, but I think Alex Gurevich and I think Mike Green both believe that they should have been cutting already as opposed to raising rates. Certainly shouldn't be raising and should probably be cutting. And it's because, you're seeing the economy slow, and then the signs are there, and the banks are failing, and, commodity prices are down, and they're like, what the hell? What is the Fed looking at? Why aren't they cutting? They're going to have to, and I have a lot of sympathy for that. And this is my point. This is kind of my point with the dollar milkshake, is that I'm not saying it has to happen, and I'm not sure it's going to happen. But my point is that it's an underappreciated risk in the market, that how fast things could go the other way, and dollar liquidity could disappear, and all of a sudden you're back into a March 2020 type scenario where or even last fall where the whole world's trying to get dollars and they're just not there. So to be honest, this is I think I've talked about this before too. My friend and I, who I talk to every week, he's the best money manager I know, and we're not sure what's going to happen. This is the smartest money manager I know, and he's very uncertain. He's not sure what to do right now. He's not sure whether we're going to have a liquidity event or whether we're going to continue to, grind violently sideways and higher. And I talked to him again this morning, and we were both laughing because we keep having the same conversation. for the last year, but we're kind of in the same place. And I think that's okay, because as you know, there's actually place to sit right now and actually make money. You can sit in short-term bonds or T-bills and get 3%, 4%, 5%, depending on how far out you go, and you don't have to do something right now. And I kind of think that's not bad advice. Is, you know, with a portion of your portfolio, just don't do anything. Just leave it liquid. Keep it. Keep that dry powder so that you can use it when you see a really, really good opportunity. This is a very long way to say I don't know how to answer your question.
Well, you know, anyone who watched last episode, I think the way you put it is, this is not the place you come for certainty. So, but that's the thing. I mean, nobody knows how this is going to play out, and we are just slowly trying to think things out real time together here on the show and for people watching. And I know coming into this episode, I was feeling a little hungry, but I'm nice and full from that big, hefty, violently sideways sandwich. So on that note, we'll wrap it up, and you have a good weekend, Brent. We'll see if next week continues to be more of the same. Cool. We'll see if those gold puts pay you some more, and you can slide them down a little bit further. But until then, if anyone wants to follow up on some of our previous episodes, we encourage you to do that, especially last week's. You can go to milkshakespod.com and find it there, or you can go on YouTube. Our handle or our avatar is MilkshakesPod, as it is on Twitter. Brent is on Twitter at Santiago AU Fund. I'm at John Kutsmita. We appreciate you joining us, and we look forward to having you next week. Brent, thanks so much.
Cool. Peace.